was going to start with Jeff, I think, first. And so Jeff is the group lead with Quickbooks financing at Intuit. He has more than 20 years of experience in banking and financial services. He started out at Chase Manhattan. He's been with a startup, Live Capital. And I'm also happy to say and very thankful that Intuit is the chair of the Global Innovation Forum. And Chris Halverson, Intuit's Chief Innovation Officer, is our chair. And so thank you very much for your leadership in getting the Global Innovation Forum off the ground. I thought maybe I would start by asking you, could you talk a little bit about the challenges that small businesses and startups face finding funding, including outside of the United States? And what role does technology, what role do companies like yours play in helping to bridge that gap?
Sure. So there's definitely a lot of pain out there. At Intuit, we have 5 million small business customers. My product is primarily in the U.S., but I think the pain that we see in the U.S. is occurring in other locations. Our products also sold QuickBooks in Europe, India, Australia, and most recently we entered Australia. In the small business space, when we surveyed our 5 million customers, the number one complaint, the biggest pain point, if you would, was getting financing for their business. When we dug into that a little bit more, what we found was that 60% of businesses had applied for credit in the last 2 years, but more staggeringly, 70% of them had been declined. And our businesses, they tend to be the smallest entrepreneurs. 75% of our businesses are less than 10 employees. And when we looked into it, what we found is the reason why they were declined had little to do with the strength of the business and more with this notion that it was hard to get the right data to the right financial institutions at the right point in time. And our premise was, if we could unlock that data, if we could use the QuickBooks data, which is the software they're running their business on, we could totally change the dynamic in the marketplace. So we built out our product. We're not a lender, but we do have 10 financial institutions on the platform. We use the QuickBooks data to effectively match them to an appropriate financial institution. And we show them all options, so anything from sort of these new non-traditional players who can fund quickly, because a lot of our businesses, they were great at growing sales, but they weren't great at knowing when they needed financing. Peer-to-peer lenders we have, as well as traditional SBA loans. By unlocking that data and with the customer permission, sending it to the financial institutions, we've had some really good success in the last 18 months. Funded over $100 million in loans. We're growing at over 300%. More importantly for these entrepreneurs, we funded 3,000 businesses. And when we look at SBA data, that has a multiplier effect in the economy. Small businesses work with other small businesses and entrepreneurs. And when we trace that through, we've seen about 300 million flow through. And more importantly, these small businesses, because they need the capital to close sales, hire more employees, build inventory, et cetera. And we estimate over 500 employees hired by it. So it really has a nice multiplier effect.
Thank you. Brian, I was going to turn to you next. Brian Knight is Associate Director for the Milken Institute Center for Financial Markets. He's also a co-founder and former vice president with CrowdCheck, which is a company that provides due diligence and disclosure services to companies and intermediaries engaged in online private offerings, and it's local. So Brian, so you founded this startup now at Milken. Could you talk about the role of crowdfunding in making funding more accessible, both here in the United States but also around the world?
Sure. So I mean, some of it's a definitional issue because, of course, crowdfunding can be a very broad term, or it can be very, you could just be referring to Title III of the Jobs Act. And as Congressman Pullis mentioned, that is not active yet. But this concept of sort of intermediated financing through arm's length transactions over the internet, so things like Kiva or Facebook or 506C offerings to accredited investors, intermediary of the internet, can be incredibly powerful. We see in Great Britain, they have a system somewhat similar to what we aspire to have, and their numbers have doubled over the past year from a little under £500 million to £1 billion of money transferred. And in the grand scheme of things, that's not that much money, but it does show a strong trajectory, and it shows that access to money is filtering down and becoming a broader access than was previously. And the other flip side of that is that it allows access to offerings to be obtained by a broader section of investors. And projecting down the line, of course, that's going to be important because it creates a new and different and normalized ecosystem, as opposed to just people investing through their 501k or on an exchange, and then a very narrow cadre of people doing angel investments or VC investments. We hope to broaden that scope out.
So, Johnny, maybe if you could follow up on that a little bit. Johnny Price is the Senior Director for Kiva Zip at kiva.org. He has a background in strategy consulting with Oliver Wyman, and he's also, as you'll hear in a second, British. And so, we're not making any apologies for where we are today, but I do appreciate you,
Well,
stepping
I
over the
appreciate the
threshold.
red phone box over there. That's helping to mitigate things.
So, Kiva.org is essentially in the crowdfunding space too, right? And but as an NGO with a social purpose, could you describe maybe a little bit about Kiva Zip and Kiva.org for those that are not familiar, but also touch on the impact that organizations like yours have on entrepreneurship and development?
Yeah, great. So as Jake mentioned, I lead a program called Kiva Zip at Kiva. We're a pilot program within Kiva. Kiva is a nonprofit that's now been around for 10 years. We've crowdfunded $600 million of loans to 1.4 million entrepreneurs in 85 countries around the world. Has anyone ever made a loan on Kiva? Anyone one of those 1.2 million lenders? Thank you. Normally, the Kiva model works well. We partner with microfinance institutions on the ground in those 85 countries where we operate. So once we've crowdfunded the loan, we send it to this MFI intermediary, and then they send the loan on to the entrepreneur. The Kiva Zip program that I lead, which we launched in the US and Kenya, essentially is a more direct model. So we disintermediate and send the money that we crowdfund directly to the entrepreneur. So that's kind of the innovation in the business model. We're only 3 years old. We're growing fast. To your point about how we enable entrepreneurship both here in the US and in Kenya, especially with the Kiva Zip model, I'd emphasize 3 things. The first is around access, and the previous question on how crowdfunding can expand access. For me, if banks or most conventional lenders, kind of centralized financial institutions, may have strict criteria around which entrepreneurs can qualify for a loan. It might be your FICO score, it might be 2 years of cash flows, it might be you need a certain amount of collateral. And I think it's great that Quickbooks is helping to connect lenders with borrowers through better use of data. We hope that by leveraging a crowd of generous lenders online, we have a community of over 1 million lenders who are looking to lend not for reasons of financial gain, but for reasons of philanthropy and helping out an entrepreneur. We hope that we can significantly expand access in terms of which small business owners are deemed worthy of accessing credit to launch or grow their business. So that's the first part, is around expansion of access to capital. The second, and Congressman Polis alluded to this, we use M-Pesa mobile payments technology in Kenya to disperse our loans directly to borrowers' mobile phones. That enables us to radically lower operating expenses. And so we can do microfinance a lot more cheaply. And so then we can pass that on to borrowers in the form of lower interest rates. Our interest rates on Kiva Zip are 0%. There are no fees or interest rates for borrowing with us. And then thirdly, and this is, again, something that's a concept that is akin to crowdfunding more broadly. For me, crowdfunding is not just about the money that we're enabling entrepreneurs to benefit from, but it's not the financial capital alone, it's the social capital as well. So we're connecting entrepreneurs with potentially hundreds of lenders who can become their customers, who can give them business advice, who might follow them on social media or become their brand ambassadors. So expanding access, lowering costs of capital, and then connecting entrepreneurs to social capital is, for me, the 3 things that we can do.
Thanks, Johnny. I was going to switch the conversation to payments and bring in Kay. Kay McGowan is the digital finance lead for the Global Development Lab at the U.S. Agency for International Development. She's also very kind to have stepped in on short notice, and I really appreciate it. I think protocol would suggest that our government friends would go first, but since you just learned about this yesterday, I figured I'd let some other people go first, and you could figure out what we're talking about before you stepped in. Could you talk a little bit about the role of digital payments, both as a gateway to financial inclusion, but also in terms of new business models and potential for improved service?
Yeah, absolutely, and that was a perfect segue from Johnny. So I'm happy to step in here, and I'm also noticing another reason why you may have invited me. I think I help your gender balance quite a bit. So you're welcome. I'm going to take an extra scone for this. Yeah. Yeah, so just to very briefly describe something that Johnny just alluded to, but what I work on accelerating and what development organizations are increasingly very enthusiastic about, because it offers both sort of radically new and scalable ways to approach financial inclusion, but also an opportunity to build critical market infrastructure that does enable a kind of entrepreneurship and new business model and service delivery that has never been cost effective and therefore never sustainable at the base of the economic pyramid. This is all digital payments. And I should just, given what Congressman Polis was talking about, I should distinguish that I'm not talking about math-based crypto virtual currencies. I live very much in the world of fiat currency in digital form or electronic form. That's an important distinction, because I think where Bitcoin does offer, especially the public ledger feature, offers really, really potentially powerful disruption for how finance and financial transactions are conducted. I think that's a long way off, and I do think any idea that it's going to replace fiat currency is even farther off. It's just too powerful of a tool, frankly, that states probably are not going to give up willingly. So back in the world of fiat currency, digital payments is simply the electronification of payments. And so we're all very familiar with it. We've been using it here for decades. But it's never been a cost-effective model at the base of the pyramid and in developing countries until you had really the advent of mobile telecommunications networks that provide this channel, basically, and that when you combine that digital channel for sending payments, often called mobile money, with a new model of banking, which is agent banking, and so takes access to financial transactions and financial services out of brick and mortar banks, which have a business model that really, really only works for the wealthier segments of society. You have this new opportunity to have distributed electronic payment systems. And it's no coincidence that Johnny was saying they're experimenting with Kiva Zip in Kenya, because Kenya is really the first country where you have seen a ubiquitous, very low-cost mobile payment system grow up. And it remains a great sort of example of what can happen. In terms of entrepreneurship, I think in addition to this really important point about bringing down transaction costs, which is really key, what it does is through that reduction of costs, it allows for really a whole new class of consumer asset financing, right? So if you think about the way the poor in developing countries buy mobile telephone minutes, right, airtime, it's not on the system we use. They're not using month-to-month contracts where you prepay for your time. You're buying really small little chunks of minutes. It's sort of a pay-as-you-go model, which makes it really affordable for people that only have a little bit of money at a time. And so if you think about applying that business model to any sort of service delivery, so water, power, financial services, what it does is take a whole set of people who have not been seen as viable consumers of products and services before and makes them viable customers. And that and that's both true for financial services, and it's also true for really any sort of business. And so one example, also in Kenya, and this rides on the backbone of the very famous now M-Pesa mobile money system, is a company called M-Kopa. And there are hundreds of these companies now, but M-Kopa is getting a lot of success right now because they're able to leverage this very low-cost payment network to provide pay-as-you-go solar electricity. and because they're able to use the data that's generated both by mobile telephone usage, but also by how you use your mobile wallet. So all of a sudden, people who have never been visible to any sort of financing before suddenly have a history and become, as I said, viable customers, and people can analyze their credit risk and worthiness. So USAID is among many donors that are really working to try to accelerate the growth of these systems. And we do this, as I mentioned before, not just as a way to really advance financial inclusion, which has a whole bunch of demonstrated impact and benefits for the poor to be able to stabilize their finances and mitigate risk and take advantage of economic opportunity. But because this critical economic infrastructure does provide all of these opportunities for new entrepreneurs, for governments, frankly, to do a better job, and for the private sector to come in.
Okay, so Paul, there's a reason why Paul is going last, because EY has written a number of things on finance and funding the future. So they've got a report called Funding the Future in the G20. And maybe just a step back, Paul Lawrence is a partner with Ernst & Young and a leader in their federal government consulting practice. He also serves as the partner in charge of the EY Initiative on Leadership. But I thought maybe if you could walk us through some of the conclusions from your Funding the Future in the G20 report that you all put out. Talk a little bit about why EY cares about this space and maybe some lessons for policymakers.
Sure. You might know Ernst & Young as an accounting firm, but hopefully you know us more broadly as a professional services firm. We provide help to organizations as they try to improve, and we're global in nature. We care a lot about entrepreneurs because we see our job as helping them scale. The 1 out of 10, as the congressman alludes to, that has a great idea, that wants to change the world, needs to do a lot of things that a company like ours helps with around the world. We run the Entrepreneur of the Year program as a way to recognize entrepreneurs all around the world, even in places like Africa where you might not think about it, and there's a global Entrepreneur of the Year. I had to take a moment of pause when I saw a congressman. The congressman's description is he was actually recognized as an Ernst & Young Entrepreneur of the Year, probably in Colorado, so you see it really does matter. Why it matters is we do surveys, and this is your answer to your question of, well, what do we hear when we survey entrepreneurs all around the world? It's not counterintuitive, but there is one that is. They would say access to capital matters. They would like less, more access, easier. The one I'll come back to is a culture of entrepreneurship, regulation less, taxes less, and education more and better. Outside the United States, it's a little more. We expect government to do that. So in places outside the United States, the education they would expect, well, we'd expect government to give us more education. If you ask them about access to capital, they would say, how about grants from the government to get entrepreneurs started? So the thinking is somewhat different. The combination of these things kind of connects through the one that's harder to articulate, which is the culture of entrepreneurship. Because in the United States, I would guess most of the, if not all the people here, have a story about something they heard, maybe in the telling of our history of a great entrepreneur, or someone you saw, or maybe the congressman, or just something, and that is rather natural. But outside the United States, it's not. The congressman described places where, the only people run business are a handful of families. And this is the hardest part that places outside the United States struggle with when we'd say, well, of course you want to be an entrepreneur. You'd almost have to talk Americans out of not being entrepreneurs, right? It's sort of one of those things. Elsewhere, it's a very hard sort of thing. So I'd ask you to think about, if you get one thing from our remarks today, it's how we talk about entrepreneurs in the United States. We don't talk about how hard it is, how hard these people work. We don't talk about the likelihood of failure very directly and clearly. Or stated differently, if we continue to refer to successful people as having got there by luck, if you are lucky enough to be at this high income category, we are not fostering a culture of entrepreneurship. So think about that as you describe really what goes on, and you'll see the combination of those two things actually seek to encourage entrepreneurship. And that's kind of what our report talks about.
Thanks, Paul. So I thought maybe I'd start with a question addressed to you, Jeff, but you all can jump in if you'd like. You don't all have to, but you can. I wanted to ask a version of the question that Brandon asked to the congressman. It's just, what is the appropriate role of regulation in making sure that you enable access to these innovative financial services but also regulating appropriately for the public good. I've heard Intuit talk about data that delights. I mean, how do you have regulation that's appropriate that doesn't stifle new innovations that we haven't even thought of yet?
Sure. So for us, for QuickBooks financing, definitely the #1 pain point is getting financing. But for us, our core business is creating software to help businesses run their business effectively. We built a lot of internal guardrails in place. We saw a lot of value that a lot of these small business owners going to 7 different banks, which was the way they did it in the past, and that it took weeks, if not months, wasn't a lot of negotiating power there. But if we could use the power of the network, we can bring financial institutions in that can unlock the data. We do a lot of value for the financial institutions too, right? We get them the data so they can make effective decisions. So we put a lot of guardrails on the site to limit what's the maximum rate you can do. Can technology help these folks to get lower rates? So we've taken a lot of that on our own because we feel like we don't just pass them to a financial institution to get a loan, but they stay a QuickBooks, hopefully, customer for life. Our hope is on the regulation front, there's been a lot of movement, especially with alternative lenders and peer-to-peer, and a lot of goodness that has come to it in terms of using the data to make fast decisions and to using new types of data to make the decisions. So as regulation comes down and as the industry perhaps starts to get regulated, certainly in terms of rates and things like that, we could see that occurring. But let the goodness of the technology, let things that make getting capital easier, transferring the data, make sure that that innovation is still allowed to flourish.
Can I hop in a little? One other thing we might want to talk about, and I'll focus sort of on the domestic context because that's what I know best, is not just the substance of regulation, but the structure and process of the regulatory environment. Because there's a risk, I think, that particularly for startups, so thinly capitalized, not necessarily sophisticated with regards to regulation, can't go and afford a $600 an hour attorney, that the substance and structure, or that the structure and process is daunting or non-intuitive. I mean, to take the payments example, if you look at at the federal level, which agencies regulate payments, and there's somewhere like 8 of them, and it cuts across different silos. So you can try to, you could try to start something up, and for the best of all, have the best of intentions and want to abide by the regs and all that, and just not know that, oh, well, there's this other regulatory agency out there that wasn't intuitive that they were my regulator, but then they could come in and create problems. Or, something along the lines of what we see in online finance, which is that we all understand, okay, the SEC regulates the sale of securities. And maybe for certain offerings, NASA, the state level guys, regulate certain things. But that's not the end-all be-all of the process. You also have to get the money somewhere. So that often involves an escrow, which is regulated by the bank regulators. And so people, including I think sometimes perhaps policymakers, sit there and think, okay, well, we figured it out. The SEC has this. We know where to go. We know where to look. And we're just going to assume away that, yeah, they can go use an escrow. And then because of the nature of the regulations, the bank regulators, applying the regulations that they have, come in and create problems. So, I think one thing we could do, not touching on the substance of regulation, is try to make the process and structure more transparent and more intuitive.
Well, and just to follow up on that, I think you're talking mostly about the United States right now. Then multiply that across the number of countries that startups are increasingly engaging in today. And so, to the Congressman's point, what role is there to standardize, harmonize, make clearer what the rules of the road are globally through things like trade agreements, through bodies like the World Trade Organization? Does anyone want to comment?
So I think we could be leaders by demonstrating how it works, right? I don't know that we'll be able to convince them what they're worrying about won't happen unless we show it. But I would ask you to take a much more skeptical eye about regulation, which is, given the people that are being regulated are fast and clever and smart, and governments that impose regulation tend to be none of the above, how will this really work? And I thought the congressman actually gave us a window into this, right? When he said, I was the first person to use Bitcoins, but the Federal Election Commission had never contemplated what this would be. This is the moment exactly. There will never be a regulation in advance of an entrepreneur. It'll always be after the fact, interpreted some way. And the really surprising story for me, the really surprising part of his story was the federal election actually gave him an answer. Because I would have guessed they would have stalled for 2 or 3 more election cycles, because why be the first to articulate this? So that, I think, is the notion, and I think that it's kind of like, what do the doctors tell you? First, do no harm. We'd like to believe regulation is wonderful, it's neutral, and it only makes good things better. Often it is not.
So one other thing, somewhat touching on that, is we might want to look at sort of regulatory philosophy. And sort of at a very broad spectrum, and there's no perfect example, right? There's principles-based regulation and rules-based regulation. Rules-based regulation, the regulators come up with a series of rules, you follow them, you're okay, you don't follow them, you're in trouble. Principles-based, the regulators, put forward a sort of principle, don't defraud people. Okay, well, and then, you kind of go off and you do your thing, and later on, if there's an issue, the question is, well, did you, really follow these principles sufficiently well? And at the extremes, they both have problems, right? I mean, because you want regulation to be predictable. You want ex ante to be able to say, we're going to be okay if we do this. But too many rules start really bogging things down. And we may want to, and the United States is relatively rules-based as things go. I mean, the UK is viewed as a more principles-based regulator. Australia is viewed as a more principles-based regulatory environment. We may want to look and see whether or not we should adjust the balance there, so that in the Bitcoin context, what's the principle? We want, you need to collect funds for your election under certain criteria. There needs to be certain disclosures. Whether or not it's dollars or pesos or Bitcoin, ultimately you convert it into dollars to pay for the airtime anyway. Is that really what matters, or is it that the disclosure? We've decided that disclosures are important. So are we getting the necessary disclosures? That type of thing.
Does anyone want to comment on the utility of trade agreements or international organizations, things like that? No one. All right. Well, I guess we'll move on. For Kay and Johnny, as you look around the world, I mean, Kay, you've already given, I think, one example, but who's doing it right? Can you identify maybe one country on your radar screen with best practices in terms of regulation or outreach to startup and business communities that are enabling these financial services to flourish?
I can think of one good example. I'm highly biased here, but in the UK, I read recently of there's a company called Funding Circle in the UK, which is similar to Lending Club and Prosper. It's kind of crowdfunding for lending to small businesses. And the UK government came up with a scheme where once a small business reached 80% of its funding goal on Funding Circle, the UK government gave, I think it was £20 million to complete that raise for that small business and ensure that they got the money. And so that's not just an example of a government kind of facilitating this new financial mechanism of crowdfunding, but actually directly participating in it, which is cool. That ties into a specific concept which we're trying to innovate with on the Kiva Zip team, which is this idea of social underwriting. And I think that's something which crowdfunding really can enable, and some interesting companies doing things in this space. When we accept a loan application as my team, we don't post it publicly on our website yet. We give that small business owner a private URL, and we ask them to get 15 people from their network to fund them in private before we post them publicly on our website. When we rolled out that innovation in January of last year, we saw that led to a huge improvement in our repayment rate. Another interesting data point here is that the more lenders there are on our loans, the higher the repayment rate on our loans. So when we talk about social underwriting, that's what we mean. Maybe there's a wisdom in the crowd, and if you crowdsource due diligence through crowdfunding, you might actually make better investment decisions because you've got hundreds and thousands of pairs of eyes on transactions. Now, obviously, there's counter arguments there, very, very valid ones around, the depth of insights that an investor will be able to garner from an investment they're making. But I think it's an interesting idea of social underwriting, and one which, the UK government in this investment is, I think, trying to tap into.
Sure. So I deal a lot with regulators overseas, and I would say that where you're seeing digital payments really succeed are really in two types of countries. It's places where regulators simply don't have the capacity to block what's happening, which is, you know, good, but it has a lot of inherent risks. And I mean, mobile money is really flourishing in some crazy places, and it's one of these almost counterintuitive situations where the less financial architecture and infrastructure you already have, there's kind of have a clean slate. And so then if you get kind of the right provider and the right use cases, you know, Zimbabwe, Somaliland, Democratic Republic of Congo, right? You can add to the list of the, you know, other countries in Africa. I would say the second type of country and regulator is more like what you'd see in Pakistan or Bangladesh, where you actually do have a fairly sophisticated regulator that is really working to nurture the opportunity and kind of sometimes perhaps holding back the industry a little bit, but sometimes really being helpful as well. I'm just back from 2 weeks in India, and that's a really fascinating case because you have the Reserve Bank of India that is always, for years and years and years, had a very stated, and I believe this wholeheartedly, a very clear goal of expanding financial inclusion. And yet the reins that they have kept on the financial providers and the limitations and trying to dictate the roles of state banks versus private sector, commercial providers and things has really stifled the sector. And it's interesting now to see that realization, you know, resulting in some really interesting reforms. I think that market will look very different. But there's no doubt it's hard. I mean, you know, your comments about regulators and governments in developed economies not being able to keep up with you know, FinTech and innovations. I mean, you know, I was just in Afghanistan on my way home from India, and you go into these, you know, the central bank there, and there are 6 people in the bank supervision department, you know, 6, like a couple working computers. And so you do have to think about, you know, balancing this. I mean, in some ways it's a great problem to have because it means these financial services really are proliferating, but I think that increasingly, especially in this donor-driven world, we're going to have to start focusing a little bit more on how you supervise, creative ways of ensuring compliance, consumer protection. But I would just say, you know, one last thought, and I've been working in this field now just about 5 years, and one real shift that's happening globally, I think, is this recognition that financial exclusion, that keeping people out of formal economies and denied access from safe, regulated financial services is really increasingly becoming understood as a risk. And that's very different from where we were even a few years ago. FATF, the Financial Action Task Force, actually came out with a statement just about 8 months ago that identified financial exclusion. And so that as a risk. And so that, I think, really represents an incredibly important shift in mindset to understanding that there is a greater public good, public interest in working together to expand access to the formal economy and the global economy. And it's going to be halting, and, you know, especially from regulators in the U.S., because there are so many of them, as you mentioned, and it's hard to get, you know, a coherent picture. But I think we're moving in the right direction.
Thanks, Kay. So I think given the time, we're almost at 10 o'clock. Why don't we open up to questions? We'll stick around maybe until about 10:15 or so. If you do have a question, wait for the microphone and just identify yourself, please.
Good morning. Thank you for the panel. My name is Daniel Amoud, and I'm a consultant a financial consultant, international financial consultant. And my question is, in terms of entrepreneurs, particularly for financial services, is there a need to differentiate between entrepreneurs? Because especially in terms of scalability, I love what Kiva is doing and what some microfinance institutions are doing. But I sort of realize that there are different levels of entrepreneurships, and there are entrepreneurs and that can really scale and create a lot of employment. And I think in the past, the venture capital firms have done sort of that sorting that's possible. Do you see that also? I mean, do you share that sort of vision in terms that there are different products that need to be provided to different sort of industries and different sort of people so that we can make the best use of them? Thank you. Those resources.
I can talk to that actually. I think one of the big criticisms of microfinance, academic criticisms, is that it's only serving micro entrepreneurs, and actually what's really needed for economic development in developing countries is kind of the next level up of factories that are going to employ hundreds of people rather than cottage industries that are going to employ one person. So I think that's a very fair criticism. My perspective is you need both. We at Kiva are focusing really on kind of micro entrepreneurs, both here in the US and internationally. But yeah, I think the phrase missing middle I've heard, and I think that's real. I think probably internationally there was a lot of acclaim and investment in microfinance when Mohamed Yunus won the Nobel Peace Prize a decade or so ago. And I think I probably agree with the tenor of your question, which is that there's been a bit of an underinvestment in that kind of next level up. But I think that is starting to change with organizations like Root Capital. Congressman Polis mentioned the Unreasonable Institute in Boulder. I think that's starting to change now.
One other sort of, to take it from something of a different perspective, I think that entrepreneurs should start to differentiate internally and be honest with themselves about what type of business they're running. I mean, in the securities space, I personally don't care for the phrase equity crowdfunding, because equity, the ownership of the company, is not going to be a good investment for a lot of the companies. They're actually really well suited to crowdfunding, but debt might be, because for equity to really make sense, there is either some sort of perceived exit event, an IPO, an acquisition, something where the current equity holder gets bought out and sees a profit. And that's great if you're going to be the next Facebook, but if you're going to be a small company, a local company, the local barber shop, someone like that, perfectly good, legitimate business that pays wages and creates employment, there's not that exit event, but you have revenue, and a debt option might actually make sense, and your investors will get sort of are more likely to get the benefit of their bargain. Whereas if people rush in on the first day and buy a bunch of equity in the local barbershop, they're going to be upset down the line, and there's the risk that people are going to be like, well, don't, because the thing is, it's an iterated game. The first tranche of people, the first tranche of companies, if it's a terrible experience for everyone involved, that entire asset class suffers because people just don't go there anymore. And so if people have options, and if entrepreneurs are honest with themselves about, well, if I go equity, where's my exit event? What do I tell people? Here's how you make your money back. Or if that isn't viable, what debt load can I really sustain? I think people ultimately it's going to be more successful over the long term, and both entrepreneurs and investors will be happier.
Yeah, the other thing I was going to add to that, and this is more in the bank space and the peer-to-peer lending, what we found was for these entrepreneurs, it was just so hard to tell the story. And because of that, because banks were going through so much pain asking for information, and it was very incremental and it was taking weeks, that if you could really bridge that by telling the business story and how the business is succeeding and how it's generating cash flow and how it's being used to buy inventory, you could change that whole dynamic around. So, I think for FinTech in particular and technology, the more we can enable customers with their permission to tell that story and get it to more parties, whether it's crowdfunding or banking, that's where we've seen a lot of success on our side. So.
Hi, I'm Ellen Singer. I'm a student consultant for Development Solutions Organization at Georgetown University. I was wondering, we're talking a lot about telling a story and gathering people together for social investment and everything. Where you see the future of the intersection of lending and investment and social media in the years to come?
I'll start on a downer. I'm a lawyer, so I ruin everyone's good time. I can't help it. At least in the investment securities context, people are going to have to be very careful, because as you put information out, at least currently, the way you put information out and the venue that you put information out in depending on what type of offering you're making, and that has impact all the way down the chain of your offering and onward. Two, if you're soliciting investment, you have to be very careful about what you say, because if you make misleading statements, or if you make statements that certain incomplete statements, you can set yourself up for trouble down the road. A disgruntled investor can come back and point to that and say, you see, I was misled, void my investment. And so social media and the fact that social media tends to be, more abbreviated and more impromptu and less formal, the lawyer in me in a sort of an investment context just starts freaking out a little bit. So I'll say that, and now more optimistic people can talk.
I'm very optimistic. I actually think it's a really good question, and I think it speaks to the point about regulation earlier, and that regulation can be behind. Another good example, Brian just mentioned one, another good example here is around public shaming or proclamation of delinquency or defaulted borrowers. And there you imagine kind of social media that the waters can get very muddy. And I think the regulations there, again, were kind of devised in a world which did not envisage, the extent to which now people are more and more comfortable with sharing things on social media and online. So I think there are kind of regulatory challenges, and maybe the regulations could do with kind of a refresh in that area. Certainly on Kiva, social media is really exciting for us. We see borrowers all the time, US small businesses. I mean, this happens on Kickstarter and Indiegogo, but they will promote their Kiva loan, their Kiva Zip loan, to their Facebook or Twitter networks, and then people will come and crowdfund them with a $5 loan by coming to their page and doing that. And then conversely, once the borrower has got that loan, they might keep their lenders. Now they have this community of hundreds of lenders who've crowdfunded them. They might keep them appraised of their progress on the business and paying back their loan through social media over the course of the loan. So we really see the potential for storytelling and kind of strengthening that social capital I mentioned earlier through social media. But like Brian said, there are risks.
And if I could just add one little perspective to this as well, I'm really focused on people that are not yet on Twitter and things, but I think one of the great barriers to economic participation in the formal economy is a lack of ID. And there's a lot of interesting work that's being done now in sort of digital identity, right? And that hasn't been solved yet, but I do think that there's potential as more people now come online and are participating, especially in social media. I think that could be a very interesting bridge to solving some of the access, the sort of core access problems.
Can I just come back on that as well? So I think the coolest part of what we do on Kiva Zip is that our borrowers in Kenya, these are people living in the slums of Nairobi, which is for me about the poorest place in the world. They have mobile phones, and if you lend $5 to them, you can send them a message on our platform, which they get as an SMS on their phone. And then they can reply to that SMS, which you get as an email in your inbox. So now you're talking to this borrower who's, has a grocery store in Kibera or is a farmer in remote rural Kenya. And so they might not have a Twitter account or a Facebook page, but they're now interacting with lenders from around the world. I was in Kenya a couple of weeks ago, and I went to see this borrower. She's actually an M-Pesa agent herself. And when I saw her, I said, do you understand what's going on here? Do you get that people around the world are crowdfunding you? And she totally got it, and she specifically called out one of her lenders, Anders, who lives in Sweden, who she's been having this conversation with, and she said, oh, say hi to Anders for me. So.
Yeah, I would just make the point about risk, right? I think your initial remarks about sort of the misexpectations, this is risk-free, gee, what a great deal, and later you find out it's not. I also think that we can continue to educate consumers about what's really going on and be kind of straightforward and say, These are highly risky things. Here is what potentially could happen. The congressman said as much. You're going to lose your money, not unlike when you gamble. But there are classes of people who will find this interesting, motivating, and whatever. So I think that we can do a better job of essentially aligning people. And I believe as people get smarter about what's going on, they will be interested in these other vehicles for a whole range of reasons. So I'm positive, but I'm also, believe it's about the transparency.
So why don't we have our last question here?
So again, I work for Visa, so we get really excited about a lot of the stuff that Kay outlined. But in addition to my day job, I also consult with entrepreneurs who have market-driven solutions to development challenges. And so it affords the spectrum of a large multinational corporation all the way down to the recipients of crowdfunding and microfinance. And one gap or opportunity I've noticed, and I would love this to be a conversation starter, is with financial literacy. So we do a lot of scalable programs in partnership with government entities, but as I guess the proliferation of microfinance and lending reaches new potential business owners, how can we cultivate responsible businesses and business practices, and how are you guys educating those recipients of funding so that they can just understand beyond just peer-to-peer lending how to better participate in new financial services?
So Kay, I've heard you talk about this before. Do you want to start?
Sure. So I think that's a great question and a great point, and it sort of, I think, harkens back a little bit to what I was saying. I think we have to be very creative about this, because in many of the countries that you're starting to see these new classes of financial service proliferate, there's just not a huge amount of capacity in the government and the regulators to supervise. The most interesting things that I've seen going on recently actually have to do with how products are designed themselves. This whole idea of human-centered or user-centric design, I think, has a lot to do with how you're explaining both the risks and the opportunities and the responsibilities involved in different financial services. So I would say that's what gets me excited about new approaches to financial literacy, and probably more importantly to financial capability.
I get excited about the potential of technology here. Like every one of our borrowers in Kenya, even if they're living in absolute poverty, which most are, have a mobile phone. So we can, we don't do this, we're very resource constrained, so we haven't developed these suites of services yet, but I dream of sending them tips via SMS of, hey, you should save every day, and even gamifying it, right? And M-Pesa has access to what they're saving, and so they can really encourage them through text messages or other digital means, and kind of train them and coach them in financial literacy. I think there's a lot of potential there. And there's some really cool companies doing some good stuff in that space.
Yeah, I was going to add, too, something interesting that we've learned. A lot of small businesses, this is really US-based, the owners identify themselves as financially literate. They started the business, they got going. But as they started to go in the process, it was a little overwhelming, and there was a lot of terms and things that didn't make sense. We tried to look at some of our different business units at Intuit, and we looked at TurboTax, for example, and said, what if we turn this around and make it more an interview where we're just going to ask you some questions, and then we'll help you in terms of what's the best financing. And let's make that very transparent. And on the offer page, let's give guidance, let's give pop-ups. But part of the problem with financing is it's such a scary journey to begin with that if we can set it more as an interview and celebrate how your revenue is growing and all these other things, the outcome is much better for the owner, and we're teaching them as they go along. So.
And I don't have a broad, scalable answer to this, but I continue to believe that the best examples are the connections through the technology, as you described, large businesses bringing people in to work with them. We support, at Ernst & Young in our McLean office, we support a school where they have students who are in non-traditional environments, and they come in 40 hours a month individually, and they work in our support service, things Xerox room and whatever, but this is the first exposure they've ever had to a business world. And we think if we can show them how to do this, business will become more natural. The connects are there. We just got to figure out how to do it. So I think the real challenge is, how do you get these things going? Because I continue to believe the example he described of people getting texts, like they'll have such context and the advice will be so relevant, it'll be just hard to recreate in a class, in a webinar, in a whatever. And I continue to believe, you sort of talk about Afghanistan, I've always sort of imagined, like, what would happen if you could say, hey, I want to run a restaurant in Afghanistan. I just don't know how. There's probably a highly successful Afghanistan restaurant somewhere in the United States, maybe San Francisco. If they were texting him and say, here's what my menu looks like. This is what I'm doing. And that kind of connection would be so powerful. So,
Did you want to say anything?
Well, I guess the one thing I would say is that I do think it's very important for business to be very much involved in this, in no small part because as technology opens up different financial products to more and more people, the sort of default or de facto barriers that used to exist, so the de facto sophistication barriers where, well, if you had enough money to participate in this type of product, you probably picked up at least a certain amount of sophistication along the way. As that breaks down, it's important. I mean, going back to sort of the iterated game scenario, right? I mean, if you have your first run and a lot of people don't have the information necessary to make it work and feel like they were cheated, it's going to delegitimize the product and the process and the players, the businesses, the nonprofits, everyone involved in the space, they're going to be seen as sort of in on the game. Whereas if people are informed enough and feel like they have the tools to make decisions, even if it doesn't work out for them, if they can point to them like, okay, well, I forgot, I should have saved more, whoops, I'll do better next time. You're going to have, I think you're going to have higher legitimacy. People are going to perceive the game as fair, and we'll all just go play it again, rather than the game is rigged, and we should just get rid of it.
Well, look, thank you all very much for joining us this morning. Here at the Global Innovation Forum, we consider ourselves a startup within a larger organization. We're part of the National Foreign Trade Council Foundation, but we're a separate entity, and we're trying to do something a little bit different, which is to try to bring all of you together. So I hope you'll keep in touch. Hope you'll join us in future discussions. We're going to provide some takeaways from this discussion, and so we will be in touch. And I suspect for all of you who didn't want to comment on the importance of trade agreements, there are several negotiators in the room who will now flock to you and tell you how important they are. So thank you all very much for joining us.